So good evening to everyone. So we are starting our June 2024 crash within next 2 more minutes. I'm expecting more students to join because there are plenty of students. I don't know where they are right now. So just wait. Okay, students are slowly and gradually they are coming. Let me see if this camera works properly. I hope it should work. It is working, I think. Okay, students, just one thing. Am I audible to everyone? I think I'm audible, but you people can also reply in the chat box. Am I audible to everyone? Yes. Okay, thank you. Just a minute. Where's the pen? Okay, I think listen. Continue recording. Zoom in, zoom in, zoom in. Okay, students. Good evening to everyone, and somewhere it is good morning as well. I'm Abil Ahmed, CEO and Principal of Abil School of Accountancy. I really welcome each one of you in my crash course of Financial Management, June 2024 attempt. Obviously, we have a really big amount of time for exams. Don't worry at all. Inshallah, in this crash, you will see that it is going to be a very comprehensive crash. And I'll try my best to cover each and every concept through questions. And more emphasis and more focus will be on MCQs and OTQs. But obviously, we'll be discussing section C question as well. But the request which I have received from, I would say, plenty of students or majority of the student, that is regarding section A and B questions. But still, I'm going to cover section C as well. Obviously, without theory, we cannot do anything. Without theory, we cannot do anything. You will see the theoretical issues from day one. Inshallah, don't worry at all. And also, I'll ask my admin to share my document of the theory. I think within 60 pages, 60 pages, I have covered the entire financial management in which you will find each and every theory. I think 60 pages, that's good enough. So let's just start. Question number 1. Student, the first question is on return on capital employed. Now, first, ROCE, return on capital employed. Another name is average accounting rate of return. Return on capital employed, another name is accounting rate of return. Now, how do we calculate actually ROCE or accounting rate of return is equal to average annual accounting profit divided by, either we divide this with initial investment or instead of initial investment, we in another formula we use average investment. So it means initial / average investment. Now the question is, sir, which formula do we need to use? Should we divide with initial investment or average investment? The answer is very simple. In a multiple choice question, it will be mentioned. In a multiple choice question, it will be mentioned by the examiner that do we need to divide average annual accounting profit by initial investment or average? Okay, now let's talk about a long question. If it comes in a long question, nothing is mentioned. It is up to you. Either you can go for initial investment or average investment. But if you ask me in MCQs, In OTQs, it will be mentioned. Okay. How do we calculate average investment? How do we calculate average investment? Initial investment plus residual value. And I hope that camera. Initial investment plus residual value divided by 2. That is your average investment. Now, please look at these theoretical issues. What sort of concepts you need to develop? What are the theoretical areas you have to know regarding this technique? Number one point. When we say average rate of return, so average rate of return, another name is return on capital employed. It actually works on accounting profit. It does not work on cash flow. It means that a technique which works on accounting profit cannot be a better technique than a technique which works on cash flows. Repeat, a technique which works on accounting for profit is not a better technique as compared to a technique which works on cash flows. So you can say that the one of the limitations of return on capital employed is it works on accounting profit. Limitations. Accounting rate of return ROCE works on accounting profit. Obviously, if it is working on accounting profit, it cannot consider the time value of money. It has no link with time value of money. Does not consider time value of money. So problem number one is it works on accounting profit rather than cash flows. Obviously, there's no question of considering time value of money. It does not consider time value of money, of course. Now listen and listen carefully. Obviously, the technique which incorporates time value of money is far more better than a technique which does not consider time value of money. Okay. When we say ROCE, return on capital employed or accounting rate of return, there's only one good thing about this technique. What is that good thing? When we are going to calculate accounting rate of return, then we have to consider entire accounting profits over the life of the project. For example, if the project is having a life of 4 years, so we are going to consider the profits over all 4 years. It means that it is not like a payback period method. In payback, what happens? In payback period, we just stop at a point where we recover the initial investment. In payback, we don't consider each and every cash flow. We don't consider all the returns over the project life. So there's only one good point regarding return on capital employed. That is, we are going to consider each and every profit over the life of the project. So I think now every one of you should be having an idea of the limitations of accounting rate of return, as well as there's only one good point which I've just discussed. That is, while calculating accounting rate of return, we consider all the profits over the life of the project. Now let's come here. What is the return on capital employed for the lorry using average investment? We know that how to calculate average investment. Initial investment plus RV divided by 2. Even there is no RV, take it 0 divided by 2. Initial investment plus RV divided by 2. NW company is considering investing 46,000 in a new delivery lorry that will last for 4 years. How many years? 4 years. After which time it will be sold for 7,000. Now it means average investment. Why we are working on average investment? It is mentioned that we need to use average investment. So average investment is equal to initial investment is 46,000 plus scrap value, which is 7 divided by 2. 46,000 plus 7 divided by 2. I'm getting 26,500 average investment. Okay. Depreciation is charged on a straight line basis. Forecast operating profit losses to be generated by the machine are as follows. In year one, there's a profit of 16,500. Second year, there's a profit. Third year, profit. Fourth year, there's a loss. So since we have just discussed, there's only one good thing about ROCE, that is we consider all the profits over the life of the project. So let us simply add all of them. Obviously, loss will be deducted. 16,500 plus 23,500 plus 13,500 minus 1,500. I'm getting 52,000. Total profit over 4 years, 52,000. We need to convert that into average annual accounting profit. So we just need to divide this by 4. 52,000 divided by 4. I'm getting 13,000. So here comes your ROCE. 13,000 divided by 26,500 into 100. So let's see what is the answer. I'm getting 49%. Perfect. It is 49%. I hope I have discussed all the theoretical issues relating to accounting rate of return. Now, one more thing which you should know. What is that? Why we are using? Please. Abdullah Imtiaz, please listen. In return on capital employed, we are working on accounting profit. Can I say while calculating accounting profit, we do deduct depreciation? Yes or no? I think we should be having a really good idea about this thing. If you're working on a technique which works on accounting profit, so obviously, while calculating accounting profit, we have to deduct depreciation. Is this clear now? That why we deducted depreciation? Yes. Now listen. If somebody asks you the difference between cash flow and accounting profit, obviously the first answer is there are number of differences, but obviously we have to make financial management simple. Just to make financial management simple, we talk about only one difference. The name of the difference is depreciation. Actually, while calculating accounting profit, we deduct one non-cash item, and the name of that non-cash item is accounting depreciation. So please never forget one relationship. The relationship is cash flow is equal to accounting profit plus accounting depreciation. Cash flow is equal to accounting profit plus accounting depreciation. So there's a possibility that examiner gives you accounting profit, but you need cash flow. So what do you have to do? Just do one thing. Just add accounting depreciation. Then your accounting profit will be converted to cash flow. Okay. Look at this, the second one. They're asking the payback period. Now, payback. Number one, payback gives you only information of one thing. That is when your initial investment will be recovered. Repeat. Payback gives you the information that when your initial investment will be recovered, that's it. We have two types of payback. One is simple payback, which does not consider time value of money. The second is discounted payback, which incorporates time value of money. We have simple payback. We have discounted payback. Simple payback does not consider time value of money, and discounted payback considers, incorporates time value of money. Okay. In exam, nothing is mentioned. An examiner has just asked you to calculate payback. Then I'll go for simple payback. Obviously, if examiner wants me to go for discounted payback, he should be using the word discounted payback. Okay. In payback period, payback works on cash flows. Payback works on cash flows. If examiner gives you the accounting profit and he's asking you to calculate payback, so you have to convert accounting profit to cash flow just by adding accounting depreciation to the accounting profit. You will get cash flow. The relationship equation is here. Cash flow is equal to accounting profit plus accounting depreciation. And payback gives you the information of only one thing, that is when your initial investment will be recovered. And returns, now listen carefully, returns after the recovery of initial investment are ignored. Repeat. Payback gives you the information of only one thing. When your initial investment will be recovered, that which means that returns after the recovery of initial investment are ignored. Okay, another thing. If we have project A and project B, let's say if your organization says that we have to make the decision on the basis of payback. So obviously, if it is a policy of the company to make the decision on the basis of payback, to accept the project on the basis of payback, so obviously, then we are going to opt the project which has a shorter payback. Okay, let's say, assuming project A is having a shorter payback, on this basis, assuming your company has opted the project, your company has accepted project A because of shorter payback, a very important concept. Even though you have accepted project A on the basis that it has a shorter payback, but now after accepting the project A on the basis of payback, if you ask payback that what is the potential effect of project A on the wealth of shareholders, then payback cannot give you the answer to this thing. So simply payback is having number of limitations. One of them is payback does not consider potential effect on the wealth of shareholders. Because if we talk, let's talk about NPV. So we know that if NPV is positive, it means that accepting that project means wealth of shareholder will increase. But if you have accepted a project on the basis of shorter payback, we cannot say that this project is going to increase the wealth of shareholder. So there are two limitations in payback. If examiner gives discount factor, no, please. Please try to understand. If there is a question and examiner has asked only the payback, that's it. And he has not mentioned, should I go for simple payback or to go for discounted payback? So I'll go for a simple payback. Simple as that. Don't worry about that. Otherwise, examiner will give you the information which will automatically lead you to the technique. Okay. So there are two problems. Number one, returns after the recovery of initial investment are ignored. The second is payback does not measure the potential effect on the wealth of shareholders. Now look at this. NW company is considering investing 46,000 in a new delivery lorry that will last for 4 years, after which time it will be sold for 7,000. Depreciation is charged on a straight line basis. We know that they have given us accounting profits. Assuming operational cash flows arise immediately over the year, what is the payback period? Obviously, we have to go towards simple payback. But the problem is examiner has not given us cash flows. Examiner has given us accounting profits. So we have to convert these accounting profits to the cash flows just by adding depreciation. So it's okay. Let's do it. T0, 1, 2, 3, and 4. Cash flows. Can I say initial investment is 46,000? Another column is cumulative cash flows. We have accounting profit 16,500. We need to add depreciation. They're using a straight line method. In a straight line method, what do we do? Initial investment minus RV divided by useful life. So 46,000 minus RV, which is 7,000. The life is 4 years. 46 minus 7 divided by 4. I'm getting 9,750. So it means the depreciation is 9750, 9750. Just add 9750, 9750, 9750, 9750 plus the scrap value. Why scrap value? Can I say in the last year there will be scrap value also? In the last year, you will be having an inflow of scrap value also. So 16,500 plus 9750. I'm getting 26,250. So we have invested 46,000. If we have invested 46, we have recovered 26,250. So how much left? How much is left? 19,750. We invested 46,000 at time 0. In T1, we recovered 26,250. So obviously then remaining amount is still which we have to recover, that is 19,750. Okay. Second year, that is 23,500 plus 9750. I'm getting 33,250. Obviously, can I say even before the end of the second year, your initial investment will be recovered? Before the end of the second year, your initial investment will be recovered. So look at this payback period. Obviously, 1 year plus 19,750 divided by 33,250 into 12. So let's see what is the answer. 19,750 divided by 33,250 into 12. So 1 year and 7 months. Yes or no? 1 year and 7 months. Okay. Look at this. In relation to return on capital employed, investment appraisal method, which of the following is correct? Number 1, please look at the questions, pure theoretical, okay? In relation to the return on ROCE, investment appraisal method, which of the following statement is correct? So you have to tell us which one is correct. Let's see. ROCE leads to better investment decisions since it uses accounting profit rather than what? Can I say absolutely incorrect? I think we did discuss a technique which actually works on cash flow that is better rather than a technique which works on accounting profit. So first one is incorrect. Second, investment project with a ROCE greater than weighted average cost of capital. Student, the second one is also incorrect. Okay, tell me why it is incorrect. Can anyone tell us why the second one is incorrect? They're saying investment project with ROCE, which is greater than WACC, should be accepted. Why the second one is incorrect? What is written? Let me tell you. Examiner has written this. Can I say ROCE has no comparison with WACC? So weighted average cost of capital we use in those techniques where we are discounting the cash flows. Where we are using Discounted cash flows, yes or no? So basically, WACC has no connection with ROC. It is like you are comparing ACC student with an engineering student. What is this? So is this clear? ROCE has no comparison with WACC. Like you people have no comparison with engineers. Engineers are engineers, but you people are surgeon. Surgeon of accounting, finance, tax, and audit. Okay, nothing else. Third, investment project with the ROC less than the current ROC of an organization should be. So they are saying investment project with ROC less than current ROC of an organization should be rejected. So normally this is not the case. Actually, if an organization makes an investment, they are going to have a target return in there. Obviously, they have to first decide the target return and they have to compare ROCE with that target return. Now we are left with only one. ROC takes into account all years of an investment. This is the only benefit. Can I say the last one is the main point? Why the last point? Can I say the last point is the one which makes ROC little bit, I would say, as compared to accounting rate of as compared to payback better. Why? In payback, what happens? We don't consider all the cash flows. In payback, we just work on when your initial investment will be recovered. So out of these all four, only one is correct. That is ROC takes into account of all years of operations of an investment project. Look at this. How many years? What is the life of the project? 4 years. We can, while calculating ROCE of question 91, we consider all the 4 years. But in payback, I think we just, even we did not go completed the second year also. We did not go for third and fourth. Okay. Now look at this. Question 94. SW company has a barrel of chemicals in its warehouse that it purchased for a project a while ago at a cost of 1,000. Can I say the cost which we have incurred in the past? It is a sunk cost, past cost, irrelevant. The cost which we have incurred in the past, it is a past cost, sunk cost, it is irrelevant. So 1,000 is irrelevant. Now what they are saying, it would cost $400 for a professional disposal company to collect the barrel and dispose of it safely. So in the past, you bought a chemical. Now, what has happened? Actually, now in order to properly dispose of that chemical, you have to bear the cost of $400. However, the chemicals could be used in a potential project which is currently being assessed. Now, just tell me, there is a chemical which you have to properly dispose of, and on that, you have to bear a cost of $400. If fortunately if you get a project where you can use the chemical, so can I say now instead of relevant cost, we are having relevant saving? There's a benefit. See, if there is no project where you could use this chemical, so you have to properly dispose of this dispose of this chemical. Obviously, if I'm going to dispose of this chemical, I have to bear the cost. It means that due to this project, we are going to save $400. So can I say instead of any relevant cost, we are having a relevant benefit? So what is a relevant cost? Actually, there's no relevant cost. Is this clear to everyone? Question 94 is clear to everyone, yes or no? Students, you can reply, please. Okay. Now, another concept of relevant costing. Actually, relevant cost means minimum cost. Relevant cost means minimum cost. And listen carefully. When there are number of alternatives available to do the same job, when there are number of alternatives available to do the same job, then according to the relevant costing concept, you will opt the alternative which is going to result in a lower cost. Repeat. When there are a number of alternatives to do the same job, then we are going to opt the project. We are going to opt the choice which results in a lower cost. Keep that in your mind. What is the relevant cost of labor to be included in the project appraisal? Okay. A new project being considered by a BLW company would require 1,000 hours of skilled labor. The current workforce is already fully employed, but more workers can be hired at a cost of $20 per hour. Okay. Option 1, you can hire people, but you have to pay $20 per hour. The current workers are paid 15. Now, don't forget one thing, your workforce is fully employed. Currently, we are paying to the workers $15 per hour and a project that earns a contribution of $10 per hour. Can I say a worker who is fully busy, who is fully employed, if you want to use that worker in a different contract, in that case, your relevant cost will be whatever you are paying to that worker plus the contribution loss. Because you have to stop the existing work. Only then your fully employed worker is going to work somewhere else. It means in option 2, the relevant cost is going to be 15 plus 10. That is going to be 25 per hour. Let me repeat. When your worker is fully employed, the relevant cost is whatever you are paying to the worker plus the contribution loss. So can I say to do the same job now, there are two alternatives. One, to hire someone from outside. You will bear $20 per hour. Second, you ask your existing people, those they are fully employed, to work for you in a new contract. Then you have to bear a cost 25 per hour. So I think the concept is, when there are a number of options available to do the same job, then according to the relevant cost, we'll opt the option which results in a lower cost. 20 per hour. How many hours do we need? I hope this is clear to everyone. Next. LW company has a half empty factory on which it pays 5,000 per annum rent. This 5,000 is an irrelevant cost, but I need to know the name. What is the name for this 5,000? What is the technical name for this 5,000? It is irrelevant. We all know that. What is the technical name for this cost? Students, please reply. What is the technical name for this 5,000? It is irrelevant, yes. Okay, let's see. Committed fixed cost, yes. Committed fixed cost is always irrelevant. Committed fixed cost, no. It's a committed fixed cost. Committed fixed cost is the cost which you have to bear in the present as well as in the future due to your past commitments. For example, a business premises which is already on rent. So obviously a business premises which is already on rent, I have to pay rent in the present as well as in the future. So committed fixed cost is irrelevant. So 5,000 is irrelevant. If it takes on a new project, it will have to move to a new, bigger factory costing 17,000. So can I say this 17,000 is very much relevant because we are going to move to a new project. We are going to move to a bigger factory because of the new project. So obviously, if because of a project, I'm moving to a new, bigger factory. So very much relevant. 17,000 per annum, and it could rent the old factory out for 3,000 per annum until the end of the current lease. Very important point. Because of the new project, two events are happening. One, we are moving to a bigger factory and we'll be paying 17,000. Relevant. In addition to that, one more event will happen. The old factory we are going to sublet. And on sublet of the old factory, we will be earning the rental income of 3,000. So these two events are going to happen because of the new project. Moving to the new bigger factory because of the new project. So 17,000 is relevant. Previous factory we are going to sublet again because of the moving to the new bigger factory. So it means we'll be generating a rental income of 3,000 as well. So can I say the net cost which we are going to bear, that is 14,000 because of this project. So because of this project, the net cost which we are going to bear, that is 14,000. Okay, now come here. Which of the following is a drawback of the payback period method of investment appraisal? It is cash flow based. Can I say cash flow based is an advantage? Yes or no? It considers time value of money. So that is also an advantage. It does not measure the potential impact. This is the problem. Can I say point number 4 has no link with payback period? So since it does not have a link with payback, so how it can become a drawback for the payback? Basically, it is profit based. It has choice number 4 is a choice which has no link with payback period. So it means only the answer is Charlie. That does not measure the potential impact on the wealth of shareholder. Is this clear to everyone? Students, please reply. Is this clear to everyone? Yes. Okay. Now let me give you one more idea. Annuity amount. Can I say annuity amount means fixed stream of cash flows for certain number of years. Obviously, this cash flow can be inflow, can be outflow. Certain number of years means it could be for 5 years, 10 years, 40 years, 35 years, but there will be a specific number of years. Okay. So annuity means you will be having a fixed annual cash flow. Could be inflow, could be outflow. But for few number of years, it could be 5, 10, 20, 50, whatever, but there has to be a number. Okay. So what is the benefit of having this knowledge of the annuity? There's a benefit. Listen. Please look at this. Simple payback period. Simple payback period. If examiner gives you the annuity cash flows, this is very important. Payback is simple. Given cash flows are annuity, then you can directly calculate the payback. Take initial investment divided by annuity cash flow. But this is only applicable on simple payback. This can be used other way around also. It means if I want to calculate annual cash flow, that is annuity amount, examiner has given you the initial investment as well as payback. So this can be used like this also. Depends on the given information. Now come here. A project has average estimated. A project has average estimated cash flows, that is 3,000 per year with an initial investment of 9,000. A project has average estimated cash flows of 3,000 per year with an initial investment. Can I say this 3,000 is an annuity amount? Yes or no? This is your annuity cash flow. Depreciation is a straight line with a no residual value of the project. Lifetime is 5 years. The company has a target return on capital employed, which is 15%. Target payback is 2.5 years. Okay. ROCE is based on initial investment. It means you need to divide accounting profit by initial investment, not average. It is mentioned here. Under Which investment appraisal method using the company's target will the project be accepted? Either ROC, payback. Now listen, very easily we can calculate payback period, yes or no? It's a simple payback, number one. We have been given annuity cash flows. Take the initial investment, which is 9,000. Annuity cash flow is 3,000. So can I say that target payback is not met? Target payback is not met. Is this clear to everyone? Okay. Now let's go for ROCE, ROC. Return on capital employed. There's a relationship which I have discussed, if I'm not wrong. Cash flow is equal to accounting profit plus accounting depreciation. If I need accounting profit and examiner has given us cash flows, what to do then? Can I say from cash flow you need to deduct accounting depreciation? Am I right? If examiner has given you the cash flow, you need accounting profit. So obviously you have to deduct accounting depreciation. So let's see. What is the amount of cash flow they have given us? Cash flow is 3,000, am I right? Initial investment 9,000, project life is 5 years. It is mentioned in the question, use a straight line method depreciation, residual value is 0. So let's see. 9,000 divided by 5, I'm getting 1,800. So minus 3,000, I'm getting accounting profit 1,200. Can I say this 1,200 is annual accounting profit? Obviously in ROC, we need annual accounting profit, which we have calculated. Here comes ROC. 1,200. We need to divide this by initial investment. Initial investment is 9,000. So 1,200 divided by 9,000. I'm getting 13.33%. Let's see. Target is met or not. Can I say even the ROCE is not met? ROC target is 15%. Project is giving us 13.33. So obviously on the basis of ROC, we cannot accept this project. And on the basis of payback, we have already rejected the project. It means, can I say neither one nor two? Is this clear to everyone? Students, please reply if you are there. Okay, great. So I want every one of you try to deal with question 99, please. Try to attempt this question 99. You have 2 minutes. Please, with honesty, I want everyone to attempt this question. Let's see. E company is considering investing in a new 40-year project, which will require an initial investment, 50,000. Okay, we got the answer. One student is saying 50%, another is saying 2.5. E company is considering investing in a new 40-year project, which will require an initial investment 50,000. Let me write here. Initial investment is 50. Project life 40 years. Scrap value is 0. Payback is 20. The 40-year project has consistent cash flows. Consistent cash flows. Annuity. Payback is 20. So we can calculate annual cash flows. Yes or no? Annual cash flow. Initial investment divided by payback. Initial investment divided by payback period gives us annual cash flow. 50,000 divided by 20. Project life is 40 years. Scrap value is 0. Accounting depreciation. Can I say initial investment divided by? So your accounting depreciation is 1250. Here comes your accounting profit 1250. Come here again. We need ROCE using average investment. Average. Can I say initial investment RV 0? One two five zero divided by 25,000. So we are getting 5%, not 50. I hope this should be clear to everyone. We are not working on initial investment. Examiner has categorically mentioned that we need to work on average investment. That is why it is 5%. If we use initial investment, then it will be 2.5. But obviously it is mentioned average, so we have to go towards average. Okay. An accountant is paid 30,000 per year. Spends 2 weeks working an appraising project alpha. Why should the accountant not charge half of her month's salary to the project? Because her salary cannot be apportioned. No. You can apportion. You are saying by yourself how many weeks she has worked on the project. Because her salary is, can I say her salary is not incremental? In investment appraisal, we consider incremental cash flows. So basically, the answer is this one. Okay, now look at this. Present value of annuity amount is equal to annuity amount into annuity factor. Present value of annuity amount, it is equal to annuity amount into annuity factor. Okay. How do we calculate annuity factor? 1 minus 1 plus I bracket minus n divided by I. By using this formula, we can calculate annuity factor. But you should know one thing. This formula actually starts from T1 onwards. For example, cost of capital is 10%. I need annuity from 5 to 10. Let's say examiner has given us cost of capital 10% and examiner has asked us to calculate annuity factor from T5 till T10. What are we going to do? Let's first calculate annuity factor for the 10 years. Then can I say, since you need annuity from 5 onwards, so just deduct annuity from 1 till 4. So you will get your answer annuity from 5 till 10. Let's see what is the annuity factor for 10 years. I'm getting 6.144. For first 4 years at 10%, annuity factor is 3.17. 6.1445 minus 3.17. 2.9745. So look at this. Present value of annuity amount, it is equal to annuity amount into annuity factor. So you should be able to calculate annuity factor if it is required from other than T1. No. Now I want everyone to attempt this question again with honesty, please. Everyone should attempt this question 101 with honesty. You have 2 minutes to attempt this question. Okay, student, let's try together now. An investor has a cost of capital 10%. Okay. She is due to receive 5 years annuity. How many years? 5. Starting in T3. 7,000 per year. What lump sum amount would you need to offer today to make her indifferent between annuity and your offer to the nearest? So all you need is, can I say, just calculate the present value of this annuity amount. Let's try. Annuity begins from T3, okay? Don't forget this. First, you have to calculate annuity factor from 1 till 7. Then simply deduct first 2 years. Then you will get annuity factor from 3 till 7. Can I say annuity factor from 3 till 7 means 5 years? It is written in the question, annuity is for the 5 years and begins from T3. So you can count the time period. Obviously, from 3 till 7, there are 5 years. Cost of capital is 10%. So please, let's calculate what is the annuity factor for 7 years. I'm getting 4.868. 4.868. Just deduct annuity of the first 2 years. That is, I think, 1.735. So 4.868 minus 1.735. I'm getting 3.133. So 7,000 multiplied by 3.133. I'm getting 21,931. Why you people got a very different answer? It is 21,931. Now let's discuss one more concept. Perpetuity amount means same cash flows forever. Same annual cash flow forever. How do we calculate the present value of perpetuity amount? Actually, present value of perpetuity amount is equal to perpetuity amount into perpetuity factor. Present value of perpetuity amount, it is equal to perpetuity amount into perpetuity factor. How do we calculate PF, perpetuity factor? That is simply 1 upon WACC. 1 upon cost of capital gives you the perpetuity factor from T1 till T infinity. Okay. What if your examiner says cost of capital is 10% and we need PF, let's say from 5 till infinity. Okay, student, first I want you to try. What is the answer of this? Cost of capital is 10%. I need perpetuity factor from 5 till infinity. Please attempt this quickly. 6. So we got 6.83, we got 6.209, 9.31. Let's now solve together. First, we'll calculate PF from 1 till infinity. That is 10. Now you need PF from 5 till infinity. If you need perpetuity factor from 5, just deduct annuity factor for the first 4 years. Annuity factor for the first 4 years at 10%, that is 3.17. $6.83. I hope now it should be clear to everyone. How to calculate perpetuity factor when it is required not from T1. No. That's great. It is clear to everyone. Okay. Student, I want every one of you quickly attempt this question 102. Please attempt this question 102. You have 2 minutes to attempt. Let's quickly solve. A newspaper reader has won the first prize in a national competition and they have a choice as to how they take the prize. So I really want to know in which country it is happening, where newspaper reader is getting such a big prize. Option 1. Take $90,000 per year indefinitely, but it will start from T3. Then that person, children, grandchildren, and so on. Okay. Cost of capital is 10%. Let us first calculate the present value of option 1. We need perpetuity factor from 3 onwards, okay? First, we have to calculate PF from 1 till infinity. Since we need perpetuity factor from T3 onwards, so simply deduct the annuity factor of the first 2 years. At 10% cost of capital, annuity factor for the first 2 years is 1.735. Here comes the PF, 3 till infinity. 10 minus 1.735. 8.265. Cash flow is 90. $7,43,801. Okay. 7,43,850. Option 2, lump sum 910, but in T1, okay. T1 9,10,000. If cost of capital is 10%, then in T1 discount factor is 0.909. So 9,10,000 into 0.909, I'm getting 8,27,190. So can I say obviously option 2 should be chosen because it has a higher present value than option 1. Option 2 because it is worth more in present value terms. C. So everyone with C is having the right answer. Okay. JCW company is appraising opportunity to invest in some new machinery that has a following cash flows. Investment is 40. Net cash inflows for 5 years in advance is 12,000 per year. We have decommissioning costs after 5 years is 15. Cost of capital is 10%. What is the NPV of? We can very easily calculate NPV. Question 103. Question 103. If I just show you the timeline, 0. Since net cash inflows are there 5 years in advance, so it will be look from T0 till T4 and decommissioning cost will be in T5. So initial investment is 40,000. Cash flow is 12 here. Decommissioning cost is 15. Cost of capital discount factor is 10%. Now logically I need annuity factor from 0 till T4. How to calculate annuity factor from 0 to 4? Very simple. First, we need annuity factor from 1 to 4. At 10% cost of capital for the first 4 years, annuity is 3.17. Add discount factor of year 0, which is always 1. So it is 4.17. Discount factor T5 is 0.621. No, 4.79 is incorrect. The correct answer is 4.17. Is this clear to everyone? The correct annuity factor is 4.17. First, we have to calculate annuity factor from 1 till 4. Then simply add discount factor of year 0, which is 1. Now I think we can calculate NPV. Yes or no? Let's see quickly. What is the answer? 40,000. 12,000 into 4.17. I'm getting 50,040. 15,000 into 0.621. So 9315. One student can't hear me. What about others? Please reply. Am I audible to others? Am I audible? Yes or no? If I'm audible, so please, student, anyone who is not able to listen to me, please rejoin. No, just because of the internet issue, I believe. Otherwise, I'll ask the admin to look at this. 9315. I'm getting 725 NPV. Okay. Cost of capital is 10%. What is the NPV to the nearest 100? It means 725 is nearest to 700. Am I right? 725 is nearest to 700. So student, you should try this 104 if you have time. Right now, there's around approximately, I'm taking a 30 minutes break of the prayer break. So within 30 minutes, inshallah, a little bit before that, we will resume the class. And before resuming the class, I will drop the message in your relevant WhatsApp groups. So see you all, inshallah, within 30 minutes. Let me pause the video. Otherwise, the video is going to be okay, students, we have answers. That is 13%, 13.31. Okay. All the answers are correct, obviously. There's no doubt about it. But let me tell you one thing. Obviously, all those shortcuts which are available in financial management, you are supposed to use them. Whenever it says IRR, so it's better to use the shortcut. Let us use also. Let me show you the shortcut. Data is initial investment 70,000, then every year we have 20,000. Project life is 5 years. Let us go to Excel. Just a minute. Excel. Let me share this with you. So all those shortcuts, like we do have a shortcut of NPV, shortcut of IRR, so you're supposed to use them. I hope that everyone can see this page. Yes. Okay. The project life is 5 years, if I'm not wrong. Put it down. No, it's fine. Time 0, 1, 2, 3, 4, and 5. Initial investment is 70. Just take cash flows to save the time. That is negative 70,000. Then we have 20,000 every year. Am I right? Oh, 20. So option of the drag will work, obviously. Now let's calculate IRR is equal to IRR. Take all the cash flows, shift, and then arrow with the right direction, close. It is 13%. So everybody was correct, I believe. So I hope this shortcut is clear to everyone. Let's go back to this page. We are back. Just a minute. Okay, students, when we need to accept only one project out of many, so the best investment appraisal technique is NPV. So simply you need to opt the project which gives you the highest NPV. For mutually exclusive projects, students, mutually exclusive project means rule of or. Means you can opt only one. You cannot opt all of them. Even you have money, still you cannot opt because they are mutually exclusive. They are alternative of each other. So simply we are going to choose which project? The project which has highest NPV. Project D on the basis of highest NPV. 106. Which of the following are correct advantages of IRR approach? To invest, appraisal, and which are not. So we have to decide which are the correct advantages. See, number 1 is a clear decision rule. Students, can I say incorrect? Question is why incorrect? Come here. Please try to understand why incorrect. For example, I'm assuming we have NPV positive 10 million. We have positive NPV 10 million. And let's say cost of capital is 10%. Cost of capital is 10%. We know that if one NPV is positive, in order to get IRR, you need to increase cost of capital, assuming. Now we are having a negative NPV 2 million at cost of capital 20%. Can I say when you have one positive NPV, another negative NPV? In that case, by using formula, when we'll be calculating IRR, can I say then IRR logically will be more than 10%? It will be less than 20%. Students, please reply yes or no. If you have two NPVs, one positive, another negative, obviously then IRR comes in between. If this is the data that at 10% NPV is positive, at 20% NPV is negative, so definitely your IRR will be in between these two percentages. Yes, no, please reply if you are there. Yes, okay. I'm just assuming. Let's say your cost IRR is, I'm just assuming your IRR is 15%, okay? And let's say your cost of capital is 10. So you will say, since IRR is more than cost of capital. So we should accept. Okay. Now let me show you one more scenario. Let's say cost of capital is 10%. I'm assuming that NPV is negative 8 million. If NPV is negative 8 million at 10%, so obviously you have to reduce another cost of capital to get positive NPV. Cost of capital. I'm assuming it is 5%. And just an assumption, still we are having NPV, but now we have NPV 1 million negative. Please try to understand. At 10%, you have a negative NPV. Then we reduce the cost of capital. Still, we are having a negative NPV. Can I say in this situation, your IRR will be in fact lower than 5%? Yes or no? Please reply. If there are two cost of capitals, on both of them, you are getting a negative NPV. Then your IRR will be lower than the lower cost of capital. Now try to understand why the first point is incorrect. When we say clear decision, listen. Here, we calculated the IRR and IRR was 15%. We said IRR is more than cost of capital. We should be accepting the project. But here, actually my IRR is not going to be more than cost of capital. Logically, my IRR is going to be lower than the cost of capital. So the question is, do we need IRR higher than the cost of capital, or do we need IRR lower than the cost of capital? This is the problem. Another problem is also there. In case of non-conventional cash flows, same project produces multiple IRRs. If same project produces multiple IRR, then which IRR should I compare with the cost of capital? That is why we say IRR does not give a clear decision. Takes into account time value money. Yes, this is correct. Assume funds are reinvested at IRR. Can I say this is disadvantage? It is not an advantage. Considering the whole project, yes. Okay. This is very important. Let me show you some. Let me time T0, T1, T2, T3. I'm assuming cash flows, we have 10,000. Let's say 10, 2, 8. Discount factor, let's say 10%, 1.909, 0.826, 0.751. Calculate. 10,000 negative, 9090, 2,000 into 0.826, 1652. 8,000 into 0.751. Let's see what is the NPV. Obviously, it will be positive 1652 plus 9090. I'm getting positive 6750. I'm getting NPV positive 6750. Okay. Let's take these cash flows again. 10,000, 10,000, 2,000, and 8,000. Discount factor, let's say 12%, 1.8 893.797.712. 8930. 2000 into 0.797. 1594. 8000 to 0.712. I'm getting 5696. Let's see what is the NPV. Obviously positive, but what it is? 5696 plus 1594 plus 8930 minus 10,000. 6220. Look at this. Cost of capital 10%. NPV is 6750. We have increased the discount rate. NPV is reduced. Come here. A project has an initial outflow followed by years of inflow. What would be the effect on NPV and IRR? An increase in cost of capital. Can I say your NPV will decrease? Are you getting this point? Now let's talk on this IRR. What will be the effect on IRR? Let's see. What will be the effect on IRR? Let us first calculate IRR by using a formula. I want you to use the formula as well. We are having two positive NPVs, okay? Okay, since we are having two positive NPVs, can I say your IRR will be higher than the higher discount rate? 10%. NPV is 6750 minus 6220. 12 minus 10 and percentage. So let's see what IRR we are getting. 6750 minus 6220. 6750 divided by this into 2. Students, I am getting 35.47. Please, can anyone confirm this? Or do I need to confirm by myself? So you should confirm by yourself. It is okay. Okay. Now, let's try. Instead of 12, if we go for 20. T0, T1, T2, T3. Cash flows. 10,000. 10. 2 and 8. Assuming discount factor, we have assumed 20%. 1.833.694.579. So, okay. Present value of cash flows, negative 10,000. 8330. 2000 to 0.694. 1388. 8,000 into 0.579. 4632. Let's see what is the NPV. It is positive. 4632 plus 1388 plus 8330. I'm getting positive 4350. Now if we use 10% and 20% to calculate IRR, let's see what happens. 10% at 10%, NPV is positive 6750. 4350. 20 minus 10. 6750 minus 4350. In the denominator, I'm getting 2400. Multiply by 10. I'm getting answer around 38%. Student, please check. Yes or no? Now, please try to understand. Earlier, we were getting 35. 35.47. Now we are getting 38. It's just a little difference. Logically, when you increase cost of capital, your NPV will reduce, but increase in cost of capital will have no effect on IRR. No effect. Why no effect? This is just because we are using, I would say, a calculator. So a little bit difference is coming, but logically there is no difference. Why? Actually, IRR is a discount rate which gives you NPV 0. So when you are increasing the cost of capital, logically it will have effect only on NPV, no effect on IRR. Which means that IRR, no change on IRR. Why? Because IRR is a discount rate which gives NPV of 0. Okay. 108. A lease agreement on NPV, that's a negative NPV, okay? 26,496 at a rate of 8%. The lease involves an immediate down payment of 10,000. Immediate means at time 0. Followed by 4 equal annual payments. What is the name for this 4 equal annual payments? If you have same annual cash flows, what is the name for that cash flow in financial management? Students, please reply. Equal annuity payments. Can I say annuity amount? What are they asking? What is the amount of annual payment? They are asking annuity amount. Okay. NPV is negative 26,496 is equal to. The lease involves an immediate down payment at time 0. Negative 10,000. Followed by 4 equal annual payments. Okay. Minus. Please try to understand. Annuity amount into annuity factor. First, please answer this. Have you understood this equation? Negative NPV examiner has given us, I've written the negative NPV. T0, we are making down payment immediately. So obviously that is an outflow. Then further 4 equal payments. So all are outflows. Is this clear to everyone? Student, please, you can reply. So we can do one thing now. This is negative 10,000. If I bring this to the other side of is equal to, it will become positive. Minus 26,496 plus 10,000 is equal to minus annuity amount into annuity factor. I need annuity factor at 8% for the first 4 years. Annuity factor for the first 4 years at 8%. 1 minus 1.08 minus 4 divided by 0.08. 1 minus 1.08 minus 4 divided by 0.08. I'm getting 3.312. Now, please, negative 26,496 plus 10,000. It means we'll have the answer minus 16,496 is equal to minus annuity amount into 3.312. Can I say the negative sign with this negative sign will be cancelled out? So 16,496 divided by 3.312 will give you the answer. 16,496 divided by 3.312. 4981. Beta. Okay. Which of the following statement about NPV and IRR is accurate? Can I say while calculating IRR? How many NPVs do we need? Now we have a shortcut, that's a separate thing. But logically, how many NPVs do we need to calculate IRR? Students, please reply. How many NPVs do we need to calculate IRR? 2. Simply, this is your answer. 2 NPV calculations are needed. Nothing else. Question 110. Polo plans to buy a holiday villa in 5 years' time for cash. He wants to buy the villa in T5. He estimates that cost will be 1.5 million, not today, in T5. He plans to set aside the same amount of funds each year. What is the name for this same amount of fund each year? Can I say annuity amount? Same amount of funds each year for 5 years. Starting immediately means from T0. Earning a rate 10% interest per year compound to the nearest $100. How much does he need to set aside? So logically, you need to calculate annuity amount. Please try. I want every one of you to try and give me the answer. Let us solve together. Never forget one equation. Present value of annuity amount. It is actually equal to annuity amount into annuity factor. Okay, let's see. Present value of annuity amount, it is equal to annuity amount into annuity factor. Okay. This gentleman needs 1.5 million, not today. 1.5 million is needed in T5. Is this clear to everyone? Actually, in T5, this individual needs 1.5 million. This individual needs 1.5 million in T5. Can I say if this individual needs 1.5 million in T5, not today? So can I say this 1.5 million is a future value? Please reply on this. Can we say this 1.5 million is a future value? Where is everyone? This 1.5 million is a future value. Yes. Let's calculate present value of this. At 10%, discount factor in T5 is 0.621. So 1.5 million into 0.621, I'm getting 9,31,500. Now try to understand. Someone needs 1.5 million, not today, in the future. So examiner has given us the future value. Okay. Step 1, what we did, we have calculated the present value. Present value is here 9,31,500. So we know that if I can achieve the present value of 9,31,500, so we know that the present value of this future value of this 9,31,500 is 1.5 million. Now things are very easy. Is equal to annuity amount into annuity factor. Now try to understand, we need annuity factor from 0 till 4. There will be 5 annual equal savings and starting immediately. So at 10%, if I need annuity factor from 0 to 4, annuity factor for the first 4 years is 3.17. We need to add discount factor of year 0, which is 1. So I'm getting 4.17. So now I think you can easily get the answer. 9,31,500 divided by 4.17. So what are we getting? 9,31,500 divided by 4.17. I'm getting 2,23,381. 2,23,381. I think one of the students got this answer correct. The students, please try this. Try this question quickly. SW company has a 31st December year end. The year end is 31st December. Pays corporation tax at a rate of 30%. 12 months after the end of the year, to which the cash flow relates, means with a delay of 1 year. It can claim tax allowable depreciation at a rate of 25%, reducing balance. Okay. It pays 1 million for a machinery on 31st December. This is important. Cost of capital is 10%. What is the present value of 31st December X4 of the benefit of the first portion of tax allowable depreciation? So what is the present value of first portion of tax allowable depreciation? Please try to understand. We are making investment on 31st December X4. Okay. Amount of the investment is 1 million. If I take 25% of 1 million, so it is 2,50,000. So actually, the day of investment is 31st December X4, which is the accounting end also. So we have calculated tax depreciation 2,50,000. Tax depreciation multiplied by the tax rate will give you the saving. Tax depreciation multiplied by the tax rate will give you the tax saving. Tax rate is 30%. Can I say the saving will not be in X4, saving will be in X5, which is 75,000. But examiner has not asked us the amount of the saving. He has asked us calculate the present value. Try to understand. We are making investment at December X4. First tax saving will arise in December X5. So the gap from December X5 till December X5, there's a gap of 1 year. Am I right? So just multiply this 75,000 with a discount factor of year 1. At 10%, your discount factor is 0.909. So 75,000 into 0.909. 68,175. Okay, students, I want this 112. Everyone should attempt. It's a really good question. Seriously. Try to attempt this. Let's solve together. A company receives a perpetuity 20,000 per year in arrears. Every year you will be getting 20,000. Pays 30% corporation tax 12 months after the end of the year, to which the cash flow relates. A cost of capital is 10%. What is the after tax present value of the perpetuity? Now try to understand. Actually, we are having two annuities. Perpetuity from T1 till T infinity. That is 20,000. And tax is paid with a delay of 1 year, which means from T2 till T infinity. Now students are getting the correct answer. So tax will be paid with a delay of 1 year. And tax rate is 30%. If I take 30% of 20,000, it is 6,000. Discount factor, they have given us 10%. So obviously PF from T1 till T infinity is 10. How will we calculate perpetuity factor from T2 till T infinity? Very simple. T1 till T infinity. Your PF is 10. Just deduct the discount factor of the first year, 0.909. You will get perpetuity factor from second till infinity. 10 minus 0.909. 909. So 9.091. So this is 200,000. Minus 6,000 into 9.091. 54,530, you can say 7. 2 lakh minus 54,537. 145463. Let's see the closest option. B. Okay, now students, I just want to make few quick announcement. Number one, I'm going to send a one question in the relevant WhatsApp group. I really want every one of you to solve that question. That question pertains to section C, number one. And number two, I'm going to carry on with this crash course, and we'll be conducting classes on every Saturday, Sunday. Timings will be shared in your relevant WhatsApp groups. And I'm also planning, not very soon, but later on, I'm planning at least one long class on Sunday. Long means around 12 o'clock in the afternoon, I'll start, and then it goes till 10 p.m. inshallah. That's what I'm planning. So that we can cover, I think, many things in that class. And days, they are going to be Saturday, Sunday, so that majority of the student can obviously get the benefit from this crash course. Plus, few announcements, they are very important. I have to make the announcements. For the coming attempt, we have launched the proper online course for FR, financial reporting. Online live classes are available. I'm conducting myself. Language is English. Second course, which we also have launched for the September attempt, that is live online classes for PM. Both the courses I'm conducting. Okay. Plus, from paper 1 till last paper, all papers, proper courses are available at my college at Abil School of Accountancy, and you will find all the best faculty members there with us. For example, Kashif Kamran is associated with ASA. So Saad Altaf is associated with us. There are a number of other teachers. They are associated with ASA. So you will find all the papers, courses properly at my college. One more thing, how do we manage basically courses? If I just tell you, basically we provide, number one, the pre-recorded lectures, but along that pre-recorded lectures, to be very honest, every week I conduct weekly live revision classes. For example, in weekly live revision classes, you will get the proper revision of the entire course of AFM. If you are enrolled for AFM, you will be getting the proper revision for SBR. If you are registered with the SBR, you will be getting a proper revision of ATX. If you are enrolled for ATX, you will be getting a revision for the FM, tax, FRPM, and FRPM, as I mentioned you, it is available for the coming attempt. Online live classes are available. So is there any question? Okay, I'm going to share this. I'm going to share this today's class PDF will be shared. And one more thing, just ASA admin number, in case if a student wants to contact. Those students, they are outside Pakistan, it is 00923333666214. And students within Pakistan, it is 0333666214. That is my admin number. You can contact them. Obviously, they will facilitate you. I'm going to share the PDF, today's PDF, as well as you will get my compiled theory notes as well. Yeah, it will be uploaded on YouTube. Today's lecture will be uploaded on YouTube. Don't worry at all. So thank you very much that you people have taken out time and you have attended the live revision class. But I would say you stay with us so that for the coming classes, I'll be updating the class timings, each and everything in your respective WhatsApp groups. So thank you very much. And I always say one thing to my students, that is, have a nice life rather than just have a nice day, because life is itself very small and day is obviously very, very small. Day is just a fraction of the life. So you should have a nice life, inshallah. So thank you very much.